In 2008, while millions of Americans were losing their homes, a handful of hedge funds made billions betting against the housing market. In 2020, the stock market hit record highs while unemployment lines stretched for miles. Someone on Wall Street is getting very, very rich. This isn't a conspiracy, it's a business model. Fear is the most profitable emotion in finance. Not greed, not optimism, fear. Because when regular people panic, institutional money moves in. When the crowd runs for the exit, the professionals are buying at the door. And when the news cycle tells you the world is ending, someone is quietly positioning themselves for what comes next. The mechanism behind this isn't hidden. It's taught in business schools. It's celebrated in earnings calls. It's built into the architecture of modern markets. But most people never see it. They just feel it in their retirement accounts, in their anxiety about the future, in the nagging sense that the game is rigged, even if they can't explain exactly how. Let's explain it. Start with a simple truth. Volatility creates opportunity. When markets are calm and predictable, returns are modest. Everyone makes a little. Nobody makes a killing. The pie grows slowly, and it's divided relatively fairly among those who stay invested. But when markets convulse, when fear spikes and prices swing wildly, the distribution changes. The gap between winners and losers explodes, and the winners are almost always the same group of people. Here's why. Professional investors, the ones managing billions, don't just buy assets. They buy options, derivatives, insurance contracts against market crashes. They construct positions that profit when things go wrong, not because they're pessimistic, but because they're protected. When the VIX spikes, Wall Street's official fear gauge spikes above 30. Institutional trading desks light up. Credit default swaps, inverse ETFs, put options, volatility futures. These aren't products designed for your 401k. They're weapons-grade financial instruments that turn chaos into cash. In March 2020, the VIX hit 82, the highest level in its history. Retail investors lost trillions in paper value. Hedge funds specializing in volatility arbitrage posted annual returns exceeding 300%. Some made their entire year in 2 weeks. The system isn't built for both sides to win. Now here's where it gets uncomfortable. Wall Street doesn't just profit from fear. It has an incentive to maintain it, not through shadowy backroom deals or market manipulation in the traditional sense. The incentive is structural, built into how money flows, how media operates, how information spreads. Consider the business model of financial news. CNBC, Bloomberg, every finance website, every investing app. They make money through advertising and engagement, and nothing drives engagement like fear. Market meltdown, recession warning, experts predict chaos. These headlines aren't lies. They're based on real data, real analysis, but the framing is deliberate because fear keeps you watching. Fear keeps you clicking. Fear keeps you checking your portfolio 16 times a day. And every time you check, every time you panic sell, every time you move your money based on emotion rather than strategy, the professional investors on the other side of that trade are making money. High-frequency trading firms profit from volatility itself. Market makers widen spreads during panic. Asset managers charge fees whether your portfolio goes up or down. The financial media sells more ads. Everyone wins. Except you. The math is simple but brutal. Studies show that the average retail investor underperforms the market by about 4% annually. Not because they pick bad stocks, because they trade at the wrong times. They buy high when everyone's optimistic. They sell low when fear takes over. Meanwhile, institutional investors who have access to better data, faster execution, and sophisticated hedging strategies consistently outperform during volatile periods. The wealth transfer isn't accidental, it's designed. Let's zoom in on a specific example, the 2022 bear market. Inflation hit 9%. The Fed started raising interest rates aggressively. Tech stocks collapsed. Crypto imploded. Every pundit on television said the same thing. Get out now. Protect yourself. This is going to get worse. Retail investors fled. In 2022, individual investors pulled over $200 billion out of equity mutual funds, the biggest withdrawal in years. But institutional investors, they were buying. Berkshire Hathaway deployed over $66 billion in stock purchases in 2022. Hedge funds increased their equity exposure by 12% in the fourth quarter alone. Private equity firms raised record amounts of capital specifically to take advantage of distressed valuations. By late 2023, the S&P 500 had recovered almost all its losses. Those who stayed in or bought during the panic made back their money and then some. Those who sold locked in their losses and missed the rebound. This pattern repeats every single cycle. 2008, retail panic, institutional buying. 2011, retail panic, institutional buying. 2015, retail panic, institutional buying. 2020, retail panic, institutional buying. The script never changes, only the crisis does. So why does this keep happening? Two reasons: information asymmetry and emotional asymmetry. Information asymmetry is straightforward. Institutional investors have better tools. They use algorithms that process millions of data points per second. They have analysts who do nothing but study specific sectors. They have access to management teams, insider networks, proprietary research. Retail investors have Google and whatever their cousin said at Thanksgiving. But the emotional asymmetry is even more important. Institutions don't panic because they're not investing their own money. They're managing other people's capital, and they're evaluated over years, not days. They have risk models, they have diversification, they have hedges in place before the storm hits. You're investing your retirement, your kid's college fund, your mortgage down payment. When the market drops 20%, that's not an abstract number. That's your future disappearing in real time. So you feel the fear, you act on the fear, and acting on fear in financial markets almost always means transferring wealth to someone who isn't afraid. This is the core mechanism. Fear flows from those who feel it to those who exploit it. And Wall Street has spent decades perfecting this extraction. Now let's talk about what makes this moment different. We're living in the age of algorithmic amplification. Social media, trading apps, influencer finance. Fear doesn't just spread through cable news anymore. It spreads through your TikTok feed, your Reddit community, your group chat. And the speed has accelerated. In 1987, Black Monday took weeks to unfold. In 2020, the COVID crash happened in 19 days. The next crisis will be faster. Algorithms trade on sentiment now. AI models scrape Twitter and Reddit for panic signals. When retail investors start freaking out online, high-frequency trading systems detect it and front-run the sell-off. You're not just competing with Wall Street anymore. You're competing with machines that can read your fear before you even post it. Meanwhile, the wealth concentration continues. The top 1% of Americans now own more than 50% of all stocks. The bottom 50% own less than 1%. Every volatility event, every panic cycle, every fear-driven market crash widens that gap because the people at the top have the capital, the knowledge, and the emotional detachment to buy when everyone else is selling. The system isn't broken. It's working exactly as designed. So here's the question nobody wants to ask. If fear is this profitable, if volatility is this central to the business model of modern finance, what incentive does Wall Street have to ever let things calm down? Not through overt manipulation, but through silence, through complexity, through keeping the average person just confused enough, just anxious enough, just reactive enough to keep making the same mistakes. You can't opt out of this system. Your retirement is in it. Your savings are in it. The entire economy is built on it. But you can stop playing their game, because the only way to win is to stop being afraid. And that's exactly what they're counting on you never learning.